Hi everyone, I'm James Harte from littlefishfx.com, and thank you for joining me for this week's live analysis session where we're going to be looking solely at the issue of Brexit. So this has been a hugely important driver for markets over recent months, and ahead of the big vote tomorrow, it's important to assess where we are. However, this isn't going to be about political discussion. Instead, we're going to approach this event from a purely trading perspective, looking objectively at the matter in hand and trying to gauge possible opportunities. So as ever, if you have any questions during the session, please just write them in the chat function and I'll stop periodically to answer them. So kicking things off, first of all then, let's take a look at what the latest poll results are suggesting ahead of the voting tomorrow. Now, for those of you who have been keeping an eye on markets, you'll know that the constant flow of polling results has been the source of a great deal of volatility in recent weeks, with sentiment oscillating sharply between sterling bullishness on majority leads for the Remain campaign and sterling bearishness on majority leads for the Leave campaign. So reports 2 weeks ago that the Leave campaign was showing a growing majority saw sterling crashing lower, falling over 500 pips on the week against the US dollar. However, sentiment changed sharply last week in the wake of the sad events which saw the killing of an MP. This boosted support for the Remain campaign and saw sterling exploding higher against the US dollar. So looking at the most recent polling results then, and the reason for this surge in sterling is quite clear. So the latest ORB poll, which was conducted for the Telegraph with the results released on Monday, actually showed the Remain campaign having a 7% lead, with a majority at 53% to 46% for the Leave campaign, with 2% undecided. Now, another really important aspect of this poll, which also lent further support to sterling, is that the poll also shows a big increase in the percentage of those polled who say they will definitely vote. So this was seen jumping to 69% from 54% 2 weeks ago. The percentage of those who will definitely vote to Remain, rather. Now, on the other hand, this figure has actually fallen for the Leave campaign. This now stands at 64%, down from 69%. So this data was collected from a sample of 800 participants, the most recent poll. And so according to this polling data, the Remain campaign are firmly in the lead. However, the picture across a broad range of recent polls is far less convincing. The latest Financial Times poll tracker, so this tracks all available polls, and it actually shows that the two sides are roughly even, though the Leave campaign have the majority at 45% to 44%, with the rest undecided. So looking at both of these data sets then, the most recent poll and also this broad poll tracker, it's really clear that the decision still very much hangs in the balance, and really it's going to come down to the skew of those who as yet are undecided. Now, moves in the market suggest that traders are expecting that skew to land in favor of the Remain campaign. Now, what is also important to point out, however, is that whilst the constant stream of these polling results has caused wild gyrations in sterling's value over the recent weeks and months as traders adjust their expectations in line with the latest polling results, these polling results aren't necessarily to be relied upon. So last year was a fantastic example of just how wrong the polls can be. So polling results ahead of the UK general election last year predicted a hung parliament between Labour and the Conservative Party. However, what transpired in the actual voting was a Conservative majority. So whilst they may indeed spur a lot of volatility, they aren't set in stone, and the reality when the results are released could be quite different to what the polling suggests. So perhaps a better way to try and gauge sentiment ahead of the voting might be to use bookmakers' odds. Now, one really important development noted by bookmakers is the reporting of a large shift in sentiment over recent days, with more and more punters now backing the UK to vote to stay in the EU. So Ladbrokes are quoting a roughly 73% chance of the UK remaining in the EU, and Betfair quoting broadly the same, with a 72% chance of the UK remaining. So this is obviously a big increase on the support for the Remain campaign that's indicated by the polls, which shows roughly even to moderate support for the Remain campaign, and in some instances, support for the Leave campaign. So how does this translate into what we're actually seeing in the markets? Well, funnily enough, despite even polling results and bookmakers strongly favouring a Remain vote, retail traders are continuing to build sterling shorts. So this chart was taken from MyFX book, their community outlook, which tracks thousands of retail accounts, and it shows that traders have been steadily building short positions since May. So you can see that short positions have been building, long positions have been steadily cut. Now currently short positions are sitting at around 57%. So this is actually a little bit down from yesterday's highs of around 65%. But you can see actually, as of the last time this was checked, which was this morning, short positions were once again starting to build and long positions were once again starting to be cut. Now, as many of you are possibly aware, generally retail traders tend to be incorrect about directional moves. So this again could perhaps be further support for the likelihood of a Remain vote. It's certainly going to be interesting to keep an eye on this data over the next 24 hours and see how it starts to change once the voting opens tomorrow. So looking ahead to the voting tomorrow then, and the actual results announcements. So a few key details to point out. So the voting begins tomorrow at 7 AM, runs throughout the day until 10 PM. National turnout will be released at 10 PM tomorrow evening, followed by the first results at 12:30 AM Friday, so midnight. The final results are going to be available around 7 AM on Friday, with the official announcement made by the Electoral Commission around breakfast time on Friday. But crucially, and this is the key point, around 80% of the votes are expected to be counted by 4:30 AM on Friday. So depending on what the skew is by this point, we could have a good idea of the likely outcome, or indeed the actual outcome by that point. So the overnight session on Thursday could be quite volatile indeed. Now, interestingly also, there aren't going to be any official exit polls conducted at this referendum. And there are reports, however, that some hedge funds are actually commissioning their own private exit polls in an attempt to front-run results. So we could see some pronounced moves during the course of Thursday evening. Now, if the data that these funds collect reaches the point of statistical significance, then we could definitely see some early positioning. However, there is no way of knowing what is going to be causing the moves that we might be seeing tomorrow evening. So attempting to piggyback them is probably foolish. Now, with market anxiety so high leading up to the event, liquidity is particularly low. So orders are likely to cause erratic price moves. Indeed, JP Morgan have noted that liquidity is so low that even the smallest of orders are causing big moves. And there have been talk that Goldman Sachs has ordered its traders to clear their books so that they have zero exposure on the night of the referendum. So with liquidity so low, these erratic moves are incredibly pronounced. But looking past the night of the referendum and to the confirmation of the results, we need to consider what potential scenarios we might see play out. So market consensus is broadly aligned around sterling rallying higher on a vote by the UK to remain in the EU, and then broadly falling should the voting take the UK out of the EU. But to get a better idea of the different types of situations that might occur, the different scenarios that we might see develop, let's take a look at what the main banks are forecasting ahead of the voting tomorrow. So Goldman Sachs, first of all, see a vote to leave causing a 1 to 2% dip in UK GDP over the next 12 to 18 months. Citibank then see a 5 to 6% rally in sterling against the dollar on a vote to remain in the EU, and a 10 to 12% drop by sterling against the dollar if the UK votes to leave the EU. Similarly, JP Morgan see a 10% drop in sterling if the UK votes to leave the EU, with the BOE forced to cut rates. Again, Morgan Stanley also see a 10 basis points rate cut and a 15 to 20% drop in UK equities if the UK votes to leave the EU. Similarly, Barclays calling for a 50 basis points rate cut if the UK votes to leave. And then finally, we have HSBC who see sterling dollar to 120 to 125 if the UK votes to leave the EU. So looking at that range of bank forecasts then, it's quite clear that the consensus is for a Brexit to cause significant repercussions for the UK economy, seeing a drop in sterling, a drop in UK equities, and a forcing of the BOE's hand, leading them to ease further with rate cuts and possibly QE expansion. Now, the market reaction in the event of a vote to remain in the EU, however, is a little more unclear. It's broadly accepted that a relief rally will occur in the wake of a vote to remain, with investor uncertainty sidelined and risk assets supported, though the actual moves in sterling might be limited. Okay, we've already seen a huge rally over the recent week, with sterling making its biggest gains against the US dollar since 2008. So it seems that a vote to remain is priced in at this point, in which case we might see a short continuation higher. But then in the medium term, that rally really could fizzle out as focus once again shifts back to UK fundamentals. Now, of course, given the nature of this referendum, the effects aren't just limited to the UK and sterling and are indeed going to be global. So the UK is the EU's third largest economy, and the UK leaving the EU is going to have significantly negative effects on the Eurozone, and would also cast great uncertainty on the European Union, which has obviously been rocked in recent years by the near departure of Cyprus and Greece. Now, we've heard various ECB members in recent weeks noting the willingness of the ECB to act in the event of Brexit to provide extra liquidity. And indeed, should the UK leave the EU, markets can certainly expect further aggressive measures from the ECB. Now, should Brexit occur, then we could also expect this to significantly impact the US dollar via an unwinding of US rate hike expectations. So the Fed has noted recently the impact of market volatility and investor uncertainty stemming from Brexit. And should Brexit occur, the negative effects on the global economy and the ensuing market volatility would create a very difficult environment for the Fed in terms of raising rates. And with expectations of summer rate moves already significantly weakened, it's likely that expectations for a rate rise in 2016 at all would then falter in the event of Brexit. Now, the impact of investor uncertainty on risk appetite has already been seen starkly, with commodity and risk markets generally falling over recent weeks as sterling has weakened, aligned to polling results showing a majority for the Leave campaign, and then rallying as sterling has rallied, aligning to polling results showing support for the Remain campaign. So again, should a Brexit occur, damage to the UK, EU and global economies is likely to hamper risk markets, and this is going to put pressure on the commodity FX block. And we've seen this in recent weeks. We've also again seen those positive moves higher as risk markets have rallied, with sentiment shifting to expect a vote to remain in the EU. So should the UK choose to remain in the EU, then we can expect these recent moves in risk markets to continue. So this would obviously take some pressure off the Fed, with focus shifting purely back to US fundamentals. Now, thinking specifically then about euro dollar, so Citi are forecasting a 2 to 3% jump if we see the UK vote to remain in the EU, and a 5 to 6% drop if the UK votes to leave the EU. Similarly, Goldman Sachs see the euro dollar dropping around 4% on Brexit. Deutsche Bank, however, don't see the euro dollar falling, and they make some interesting points. So they don't see euro dollar falling if we see a Brexit. In fact, could see the pair rising due to a couple of key reasons. So firstly, Brexit would likely see the US dollar under pressure, as we just discussed, as investors dial back US rate hike expectations. And secondly, they note the tendency of the euro to outperform, with Europeans genuinely repatriating foreign assets during times of uncertainty. So in these risk-off periods, we generally tend to see the euro rising. So the moves in euro might not be totally clear-cut in the event of a Brexit. But in terms of thinking about direct opportunities, let's look at the technical landscape in play across the sterling complex and some other pairs, and see what opportunities there might be for positioning on the back of this event. So looking first of all then at the sterling dollar, and you can see that it's been a pretty wild ride over the last week. So in last week's live session, we called this 140.55 region as being a key level for sterling dollar from which we were likely to bounce. So you can see that that support did in fact hold. We noted this as being the shoulder area of this prior inverse head and shoulders pattern. So having broken down through that rising trendline support, having broken down through that key short-term support at the 143.30s, we were expecting price to find support here. However, I was only anticipating that the bounce was going to see price rotate back up to a retest of the broken trend line and that broken 143.30 support. But you can see that we actually ripped through that level, okay? The gap on Sunday night obviously took us higher. And then since then, we've continued to trade higher. So hopefully some of you were able to hold that move a little longer. Looking at the chart now then, we can see that price has made a test of that big 47.60s resistance level formed at these previous highs. And this is where we're currently stalled. So again, instead of any proper directional moves, all we've actually seen ahead of the voting is a big clearing of the order books with cable running both sides of the market. So if we zoom in here on this current period of price action, you can see that it's actually currently indicating a bearish reversal from current levels with this big bearish daily pin bar which formed yesterday at this clear triple top level. So this is quite typical, and we can certainly expect some pullback and some chop over the next 24 hours. But the key is going to be where price heads once the voting is done. So looking at the structure of this market, we zoom out again, it really feels like price has carved out a solid base at this level. And you can see that we now have an even larger inverse head and shoulders formation in play. So if we do get a remain vote tomorrow, I think that we can definitely look for a topside break of this 47.60s level and for price to finally sustain above there. And if we do get above there and hold, then the levels which I'm going to be targeting are as follows. So first of all, the area I'll be looking at is the 50% retracement from last year's highs, which comes in at around 49, up to this 49.40s level, where you can see we have some nice structural resistance with this previous low and these previous highs. So this band is generally an area which I'll be looking for price to target if we break out above this level. But really, if we do get this remain vote, then I'd probably be looking for price to push beyond that just a bit. And the level that I'll really be targeting is this higher level. So the 61.8% retracement from last year's highs to this year's lows, which comes in at 51.20. And you can see that this is also a nice area of structural resistance with this ledge of prior lows from last year. So this is a really big zone for cable. And if we do see a pop higher and we trade up into that level, then this could be the area from which we see the rally fizzle out. So that would broadly mark 400 pips worth of rally from current price levels. And what we would actually see form then is this symmetry move where we get a retracement of equal length to that last big retracement last year. So if price does trade up into this level, we test the 61.8% retracement from last year's highs, we test this level of structural resistance, and we have this symmetry resistance, then this could be an area to look to set shorts for a medium-term resumption of the cable downtrend. Now, if we do get a leave vote tomorrow, and we see cable break to the downside, well, as this isn't the move which is priced in, then this could be a fairly sharp move. And so it might be difficult to position in this. The levels which we could broadly target for cable on the downside then would first of all be a retest of the 40.55 level, which has been a very pivotal level for cable over this year. Below, the 43.30s level, first of all, the 40.55 level below that, and then obviously the 138 level, which marks the year-to-date lows. So these are the key levels that we want to be looking at with cable. Obviously, at the moment, market's expecting that we are going to get a vote to remain in the EU. We've seen this relief rally over recent days, and if we do get that vote confirmed, then we could expect some short-term continuation of this move, but I would be looking for that move to top out around the 151, 152 mark. So looking at the crosses then, and I think the clearest opportunities really are in sterling yen, sterling Aussie, and euro sterling. So looking at sterling yen first of all then, So you can see that we recently hit the lower end of this big bearish channel. We found huge support at that level and got a really sharp bounce. And you can see this has taken price right back up into a retest of this previous broken level of support. You can see that we've actually formed a really big bullish weekly pin bar. So this is a really strong reversal signal. So I quite like this pair for a long trade if we do see the UK voting to remain in the EU, because not only do we have the sterling strength aspect, but we also have the risk on play, which is likely to see the Japanese yen continue to weaken on diminished safe haven demand as risk assets rally in the wake of Britain choosing to remain in the UK, in the EU rather. So if we do get a break out above current highs, then the area which we can look to target that move will be back up into these two previous highs at around the 164.23 mark. And again, we have nice symmetry resistance there, mapping the last move up into highs. And we also have the 38.2% retracement from last year's highs coming in just above at 165. So as we are seeing with cable, this might be the level at which we see the rally fail and the broader downtrend resume. You can see we've also got really nice structural resistance at this level, this previous high, previous low, and these two highs. So this is a really nice level on the sterling yen. And if we do see a rally that takes us up as far as that, then that could certainly be the area, especially with this bearish channel resistance line coming in also, that we could expect for price to stall out and possibly reverse lower. Now, it might be, in fact, that we get an inverse head and shoulders pattern form out from that level. So you can see that we've currently got a head and a left shoulder. So if we rally back up to that neckline zone and trade back down, then we could see this 152, 153 area acting as support for another move back up. But obviously that's looking a little bit far ahead at this point in time. We're just expecting that if we break higher, this will be the target zone for long trades. And this would be the first area that I'd be considering a short trade. Okay, so the sterling Aussie then, and again, moves which are quite supportive of the base. So we obviously saw that huge rally over late April and early May. We've seen a subsequent correction stall out and we've seen a bounce. And so what we might be seeing here is the formation of a double bottom. We've obviously over the recent week seen this big expansion higher in line with the broad cable moves which we've been seeing. However, current price action is stalled in this typical bull flag formation. So this could be quite a nice pair to play on a breakout and expect a continuation of this move to map this initial leg higher. So we'd have an A, B, a retracement, C, D, taking us back up into roughly the 202.60s level. So this is definitely a pair which I'll be keeping an eye on. Again, to the downside, we've also got a nice breakdown level here. So you can see we've got a really nice support level carved out at this zone. And if we break down there, we can expect a challenge of the 91.25s to 90.15s, which again holds the broader breakout level. So if we break down below this current support level, it obviously opens up a move down to retest the year-to-date lows. So there's some nice clear-cut levels there with the sterling Aussie, which we can look to take advantage of. And generally, being a high volatility pair, these moves are much quicker, much more pronounced. So if we do get a break of these key levels, then that certainly opens up room to take on the next one. Okay, so euro sterling then. And you can see euro sterling, we're currently in the midst of a sharp sell-off from this right shoulder area of this head and shoulders pattern. So you can see that we're sitting currently just above this key support level. We've got rising trendline support from November 2015, picking up the May low. So we've got nice rising trendline support there. We've also got this area of key structural support formed at these previous lows. And so if we do break down through this level, then the level which I'd actually be looking at the euro sterling to engage in is this 74.50 to, let's say, 75 zone. So this was the breakout zone from last year. We had those two big highs which capped the rally, and then we got that breakout late last year in December, which has recently gone untested. So if we do get a move back down into that level, we'd also have this ABCD corrections. We'd have a nice corrective pattern completing into this really key structural support. So depending on the price action that we see there, this could be a good level to look to engage the market trading for a medium-term resumption of the euro sterling bull trend, which we've seen manifest over the recent year. And finally then, looking at the euro. So much has been said about the euro, about what might happen in the event of Brexit occurring. Some are looking for a sell-off, others are looking for it to stall, possibly rise. And similarly, most are expecting to see euro dollar rise in the event of the UK voting to remain in the EU. But actually, could it be possible that we see the opposite happen? Okay, so Deutsche Bank is suggesting that because of downward pressure put on the US dollar in the event of Brexit, due to unwinding US rate hike expectations, that the euro dollar would be supported. And so perhaps if we see a vote to remain in the EU, US dollar will derive support as markets will sidestep a great deal of volatility and economic uncertainty, thus leaving an environment in which the Fed could still raise rates if it sees fit, coupled then with the fact that the euro tends to outperform during risk off and weaken during risk on. So it could be that we actually see the euro dollar break lower if the UK does remain in the EU, in which case I'll be looking for price to take out this key support. So this is a level that we've been noting a lot in our recent sessions, this 110.70s to 111 area. So we've got the rising trendline support. Price found support at that level again last week as we tested it. We've got this area of structural support with these lows. And so if we do get a breakdown and we break down below that 110.70 area, then I'll be targeting a move down into this major 108 support. Now on the top side, if we get a break, then the key level which I'll be looking at, which again is a level we've been noting in our recent sessions, is this 1426 level, so 1430. You can see over the last year and a half, this has been a really important level for the euro, and it's capped a lot of upside and been the initiation point for a lot of bearish reversals. So if we do finally get a break of that level, then that opens up a move up to the year-to-date highs at around the 116 mark. So a lot of key levels to look at across these pairs then, and we've certainly got a really important and really interesting 24 hours ahead of us. So make sure to stay tuned into the website over the next few days. We'll be providing key updates as they come in. And you can also check out our trade alerts, which are currently up over 600 pips in June so far, taking us over 3,100 pips since we started giving the trade alerts in November last year. So if you're interested in those, please head to the website www.littlefishfx.com and you can check out all of that stuff, and make sure to keep a track of us on Twitter over the next 2 days. So good luck, and look forward to catching up with you all next week to see what happens on the back of the referendum tomorrow.